Hi, everybody. Welcome to our DAT IQ Weekly Market Update. This is our update for October 29, episode 313. I'm Dean Croak, Market Analyst here at DAT Freight and Analytics, along with co-host Chad Kennedy and our special guest today, Adam Wingfield from Innovative Logistics. Welcome back, guys.
Good morning.
Yeah, good to have you with us, Adam.
Glad to be here. Thank you for having me back.
Been a while, a couple of weeks.
Been a couple of weeks.
Yeah, you've been busy on the show circuit this year, right? I've seen you around at a number of events. It's been a very big year for you, I think.
Yeah. I think the biggest thing just is to keep a finger on the pulse. And I think that what we're finding that, particularly in markets like this, where there's so many unknown variables, it's so important to get your best foot forward and making sure you have a finger on the pulse on what's going on, see what everybody's thinking, see if you can find the undercurrents and things of that nature, and learn so much in the market circuit this year.
Yeah. Chad, we had our DAT Con last week, probably our most successful ever user conference.
Yeah, it was great. We had around 300 people there, shippers, carriers, brokers, had some great guest speakers, announced $1 trillion in our database that we're running our rates engines through. So it was a pretty exciting event. Yeah, it
was a really good event from a customer point of view, not just the fact that the DAT customers, but just the interaction between shippers, brokers and carriers. It was kind of unique in a way. You don't normally see those sort of different demographics sharing so much information. It was really encouraging. But of course, at the center of all that was this data transparency around. One of the common questions we always get is when we're in the room with the brokers were saying, in response to looking at our benchmarking IQ tool, that was saying, can shippers see all of this data also? And of course, the answer is absolutely.
Yeah, and we get the same question from the shippers from the other perspective. But yeah, we're kind of that non-biased third party in the middle there that sharing data with everyone, and it makes everyone better.
So Adam, what's your take on that? Like, there's this transparency in the market now where everyone's got access to similar data points. Some advocate that it's a negative, but because they want to keep their other side of the negotiation in the dark. Maybe that's a little bit harsh, but how do you see that? Like, how do you see that playing out?
I mean, you can. To me, it's 6 in one hand, half a dozen other. Because when I started, and back when you were very familiar with that, we didn't have access to that data, and it really didn't give us any much more of a leverage than we would have now. I think that ultimately, when it comes down to it, I think for us as a carrier, from a carrier perspective, sure, it would provide us with another level of visibility. And we're in 2024. 2024 is the era of visibility, and with social media there, and especially with the connections between companies and being able to be connected with their users, just like you talked about the conference and things like that, and being real time. But does it truly give us a true advantage in terms of negotiation strategies? Because ultimately, at the end of the day, if we don't come to an agreement on a negotiation, we're going to walk away anyway. So I don't know if it would provide any support from a transparency perspective. Obviously, it's going to. One thing that we can agree to is that with that transparency, I'm sure it will spike rejection rates. And when you spike rejection, then of course what that's going to do is going to improve rates anyway. So it's just a matter of supply and demand. And I think that just from a carrier perspective on a downstream side, I'm not really certain if it's going to give a big benefit. But what it could potentially do, it could be a race to the bottom. Because now you're going to provide visibility that hasn't been seen before. And now shippers going to be like, well, wait a minute. That's cheaper over there. I think we're just going to stick over here, and we got to be careful what we ask for.
Yeah, we heard the term from some of the big shippers about API carriers. Carriers just the large carriers that connect through technology platforms and avail themselves of dynamic pricing. But anyway, Adam, for those that don't know you, tell us a little bit about yourself, and then I'll dive into the market update, and then we'll come back to a little bit more deeper discussion later on.
Yes, I've been in the industry going on a quarter of a century. In 2025, it makes 25 years for me in the business. I've served in a variety of different areas. I started off as an over-the-road driver, went to fleet owner and owner-operator, and then fleet owner, and then got into the consulting side of the business, supporting small carriers and providing them with the educational structure for them to be successful in the marketplace. And one of the things that I'm super passionate about is education, right? So I really want to focus on educating smaller carriers because, as you know, we've got 90% now of them have exited the marketplace over the last 3 years as a reflection of some of the things that took place during the pandemic. But then we've also got only 15% of the freight that's available to them in the entire United States that actually lives on spot board. So what we're trying to do is do a better job of just making sure that we're providing great education and also resources to make sure they can sustain themselves.
Yeah, great point. So I look forward to bringing you back a bit later. Let's dive into the market update. couple of things we're watching. Spot rates are holding steady in the dry van market in particular. They've been sitting about where they are for the last month now. Very interesting that there seems to be a trend emerging there. The loads moved last week, were flat, but up about 2% in the last month. So we're certainly seeing some sort of an elevated level of rates in the last month compared to the downward trajectory since July 4. Jason Miller's truckload ton mile index, he was just on Sirius XM radio this morning talking about this. His truckload ton mile index that tracks 41 freight generating commodities continues to move along the bottom of a trough. No sign of substantial movement in truckload demand there. The cash shipment index, Tim DeNoyer was also at DATCon last week. He's the author of the CAS index. He's from ACT Research in Indiana. The shipments component of the CAS freight index down nearly 2% month over month. After increasing in August. Again, that lines up with a number of other data points, such as the ATA tonnage index. It ended 2 months of sequential gains, lost some momentum in September. Bob Costello reported that the index was down 2.1% last month compared to the prior month. It's also down about 0.9%. So for context, this is the tonnage index. It's the contract side of the freight market on the heavier end. Canada, manufacturing Canada is down slightly. It sort of supports where we've seen the market. Factory shipments dropped about 1.3%. We have a lot of carriers that do cross-border work. I've noticed since August that spot rates are starting to move up. I'm not sure whether that's seasonality or we're actually seeing a genuine shift in demand for carriers there as capacity continues to exit that market. This week's market update that'll be out this evening at dat.com/market update. Really good market update this week. We've got a lot of tips on winter driving from a 35-year veteran owner-operator, Rick Rickstalis. He's put together a really good document on what you need if you're a trucker. We've got some more information on ATA. We've got a bit of an update on the California grape season. And of course, the Fannie Mae home purchasing supply index is out, and that tracks pretty closely with flatbed demand, which is not so good, as we all know. All right, let's dive into the freight market. Load to truck ratio, load posts down last week, but about 15% higher than last year, their load posts. Carrier capacity was mostly flat last week. So load to truck ratio was down about 7% to 4.11. Interestingly, at 4.11, that's the second highest load to truck ratio in the last 8 years, with only 2021 showing a higher ratio for week 43, and that was at 5.25. So some pretty good numbers there. In reefer, there was a bit of a surge in volumes. The previous week, volumes did drop back last week, still about 6% higher than this time last year. The drop in overall volumes this week, partly due to an 8% drop in USDA volumes out of California. Carrier equipment posts mostly unchanged. The load to truck ratio was up about 15% to 5.53. And in flatbed, the number of flatbed load postings was down about 8% last year, still about 10% higher compared to last month and about 36% higher than last year. So across the three equipment types, definitely seeing more load post volumes this time around. Carrier equipment posts were down slightly, load to truck ratio at 14.62. All right, so let's move on to our year-over-year look at spot rates. As you can see from the chart there, the volume of loads moved was down about 1% last week, sort of supporting where capacity is sitting. Rates are fairly flat. Nationally, rates remained unchanged for the fourth week, averaging $1.65 per mile. Remember, these are line haul rates excluding fuel. That figure is about 3 cents a mile lower than the 3-month trailing average, but about 11 cents per mile higher than where it was this time last year. And in refrigerated, weaker volumes across the board led to the national average reefer line haul rate down a penny per mile. Carriers were paid on average about $1.98. That's about 11 cents a mile higher than this time last year. Notably, we're starting to see a fair bit of action in Baltimore. A lot of winter produce is coming in there. A lot of South American produce is coming in. If you've tried blueberries lately, you'll notice the difference. They're almost basketball size produce coming out of that part of the world. Line haul rates for outbound loads in Baltimore alone were up 17 cents a mile last week. Market average of $2.36 per mile on a 14% increase in volume. And in flatbed, line haul rates continue to decline. They were down another penny per mile last week, averaging $1.97. Despite this decrease, rates are still 11 cents a mile higher than where they were last year. but about 2 cents a mile lower than the 3-month trailing average. Right, let's have a quick look at our forecast. Again, a lot of seasonality here, as you can see on the charts. These are our new short-term forecasts. What we're doing here is using RateView to predict RateCast out 35 days. Remember, this has about a 95% accuracy, as we talked about at DATCon last week. We've got some upper and lower bands, exactly as it's displayed in the product. The blue line is the rolling 7-day weighted average movement of historical rates. These are loads moved over 550 miles, excluding fuel. So this is our first forecast we're seeing now, where we're getting out just to Thanksgiving. Typically, we see this kind of seasonality this time of the year. Again, shouldn't be any surprise here in the way dry van rates are predicted to move. Ratecast has got dry van rates plus 7 cents a mile out over the next month. Best case scenario up 12, low case scenario down 2, but I think Ratecast is always on the money, and that follows pretty typical seasonal patterns until we get to the end of Thanksgiving. Onto the refrigerated sector, again, you can start to see the upward inflection in spot rates that starts later this week. We typically see the intersection of Christmas tree season, fall produce, fresh turkeys starting to move ahead of Thanksgiving. So we're starting to see that lift in spot rates on the refrigerated market. Ratecast is looking for a 12-cent per mile lift. Again, that's pretty much in line with what we see in most years. More optimistic case has rates up 17 cents a mile. Worst case scenario up 6. So that again fits the typical seasonal pattern that we see. Rates typically then start to tail off after Thanksgiving and then pick up again as we get closer to the Christmas holidays. And in flatbed, a little bit more optimistic models forecast this week. The rate of decrease has slowed dramatically. Ratecast is looking for a 2 cent per mile decrease. Last week it was about a 6 cent per mile decrease. So the rates are starting to flatten out, as they do pretty much at this time of the year, before we start to see some upward inflections closer to Christmas. High case scenario plus 1 cent per mile. Worst case scenario down 6 cents a mile. So that's our forecast for this week. Chad, that's the spot market side of the equation. What are you seeing on the contract market?
Yeah, so everything I'll cover here is from the shipper to carrier or broker perspective, whereas everything Dean covered was from the broker to carrier perspective. So this first graph here in yellow is the spot premium ratio for dry van rates. Spot premium ratio is the difference between contract rates and spot rates. This is going all the way back to 2016, so you can see those market cycles. And it looks like we still have a soft market from this perspective, still coming in at negative 9%. Spot rates are on dry van 9% lower than contract rates. Interesting trend here, though, in the new rate differential graph is the last few data points we've been above 0%. New rate differential is the difference between new contract rates that we're receiving from our customers versus the rates they replaced. So we can see all that data. We can see when rates start and when rates stop, and we're comparing that difference. Most recent data point 1%. So what this means is that when our shippers are hosting their bids and they're executing on those bids, those new rates that they're getting on contract rates are about 1% higher than the rates they replaced. This is a good signal for carriers and brokers, and it's a shifting signal for shippers as we start to move into a little bit more of a potential for inflationary market on the contract side. Next graph here, contract rate index. These are 80% of shippers' rates, contract rates. We're indexing to 2016 here, and you can see pretty flat. So the 16.8 just means versus 2016, but really the takeaway here is that flat trend. So as Dean was just showing, spot rates increasing with our forecast, that could push the spot rates up above these contract rates over the next several weeks. So that'll be interesting to see if that moves that new rate differential. That spot premium ratio. So now we'll move into reefer rates. Similar trends here. We're not seeing the new rate differential up above 0 yet. So we'll continue to watch that, and still flat on the contract to declining on that contract rate index. And then finally, flatbed here, highly variable on that spot premium ratio as expected with these short-term rates. New rate differential still down quite low, negative 7%, and contract rates bouncing around there pretty flat. So it looks like on reefer and contract or in flatbed, we're still dragging along this bottom. Dry van showing some signals of tightening on that contract side. That's a wrap for the contract rates.
Yeah, thank you. Let's bring Adam back in. Adam, one of the questions I'd like to throw at you is we should see pretty solid demand this quarter, a lot of seasonality back in the market. Next year, though, as always, is going to be a challenge. We've got the highly probable ILA strike that is predicted to happen on January 15. So there's some things happening that could change that equation. But what do you think generally carriers should be thinking about heading into 2025?
I think the word for me would be just uncertainty. And the reason why I say that is because, we still have to consider that there's election that's going to take place. And, obviously the outcomes of any election, either way, one way or the other, the outcomes of the election is always going to spur one way or the other. They're going to, I say, instigate the market, right? So when we look at, it could potentially to encapsulate, new ideas and new regulations, whether it be tariffs, whether it be whatever that takes place, it's going to shake things up, and it's going to either A, cause more demand, or B, it's going to cause tightening of demand from that perspective. So I think carriers need to be very, very cautious in their outlooks. Anytime we have our election cycles and you tabulate that with, we've got some things that's happening in the Middle East. There's a lot of things going on in the world, and without considering current patterns that are happening within the overall shipper side, you also got to look at what that global economy can impact. And then also we can't forget about the fact that carriers are still exiting the market. When you look at the fourth quarter, we all know that the fourth quarter, particularly around December, is the time that you see carriers not renew those insurances because of that factor. They're not sure. They're not, obviously with the spot market being below $2 a mile, excluding fuel, you got carriers that still need to kind of look at their business from that perspective and say, hey, you know what, I might just tap out from this perspective.
Yeah.
Now, when we do that and you're considering the supply changes, and then we see a demand, it's a lot of uncertainty, to quite frankly. And I think that's something that we got to be considerate of.
12/31, when I worked at a large insurance company running we had 8,000 owner operators on our portfolio. One of the common due dates was 12/31, was a particularly busy time for underwriters. So is that a function of annual insurance payments, or would it be more likely quarterly? Because we see both. We see exodus around both quarterly and annual.
Yeah, well, you also see the total policy itself when it expires, and that's going to be an annual expiration for the most part. It's going to expire either annually or whether it be a 9-month or a 10-month. But we just traditionally see that hey, you know what, this is the end of it. This is the end of those expirations. Then you got to look at, hey, this is the time where UCR filings is going to take place. We've got the Corporate Transparency Act, which is going to go and take place. There's a lot of things that's going to make the owner operators and business owners make that decision on whether or not, hey, I'm going to continue with this business or I'm going to give it another shot. And quite frankly, just from some of the undercurrents that you can hear, at some point they were like, you know what, I don't know if I'm going to continue. I don't know if this is going to be the trigger for me to say, hey, you know what, I'm just going to just tap out at this point. But when we think about the overall exits, we're still net negative when it comes to carriers exiting the marketplace. And I don't see that trend changing.
Yeah. Do you think the Drug Clearinghouse Part 2 on November 18, that change is going to have an impact?
Absolutely. Especially for not for the single owner operators, obviously. I think more so along the mid-sized carrier base where, you have more drivers in that fold. I think that's going to cause some irregularities in available capacity. And I think that's going to change some things. So when I look at the quarter four as a whole, with the lack of a true, we want to call peak season, without the lack of a true peak season, we've got regulations going into place. You got, obviously we got an election in the next couple of weeks. There's a lot that's going on right now that could potentially spur folks to exit the market, which would cause an imbalance. And then, obviously we know what that would do for us.
Interesting.
Yeah.
Adam, can you tell us a little bit about your customer base that you serve? Is it the 1 to 2 truck owner operator, or is it the 10 to 40 truck owner operator? Where do you fit in the
we're 1 to 10. That's our ideal customer is 1 to 10, and that's going to represent about 95% of the freight that moves in America. So we represent that particular place. And this is where our information and data come from that 1 to 10 marketplace.
And is it a right assumption that like not renewing your insurance would be more common with the 1 to 2 truck versus the 10 to 20 truck operation?
I don't know if that would be a fair assumption because, I think that there's we saw several trucking companies, even in the moderate size, that kind of just closed the doors. But then when you look at it, I don't think that that's necessarily a fleet size would predicate that. I think it comes down to, hey, what's my operating ratio looking at right now? If I'm running out 100 plus operating ratio, it's not time for me to renew my insurance. Either I'm going to cut down so I can turn this OR around, or I'm just going to, I'm just going to do something differently.
Yeah.
Sure.
Adam, we've seen some of the earnings calls come out last week, and there's still fleets downsizing, ORs over 100. which is kind of surprising, seeing how that much has deteriorated. I wonder whether that just reflects a really bad third quarter, and we're at the bottom and things will improve. So I'm interested in your take on how you see large carriers playing out in the market there based on some of the recent earnings calls.
Well, I think that, you look at some of the large carriers that are fiduciary, I don't want to say responsible, but are benefiting better from their customer relations and the transaction that they have with their customers. I think it's a very, very clear, definitive line. You've got some carriers that are very, very cautious in the place. I saw some of the carriers that went in their last earnings calls and they came out on top with great ORs. So I think that that's a very, very fine line. I think it really boils down to the customers that they serve, the contracts that they have in place. I think it helps with their routing guides, and a lot of things come to where those bid cycles came through. So I think that ultimately, when it comes from a large carrier perspective, obviously they're going to cash flow a little bit better when it comes down to it. And then some of them are much more optimistic about the market cycles as they correct themselves in Q1. Some say maybe Q2. I think we've seen a carrot that's been kind of dangled out for, we've all heard it, like, okay, change is coming, change is coming, change is coming, change is coming. But I truly believe that some of the larger carriers really can kind of see something that as they start seeing those undercurrents turn around. And that's the reason why we're seeing them hold steady in the places that they have. I don't see much of change from that perspective, but I do see they taking advantage of that.
Yeah, it's interesting, Chad, on the, we talked to shippers over the course of our, travels and conferences. There's a definite sense that rates will be higher next year.
Yep.
So, and I think that because we're in RFP season,
right.
Fourth quarter is always RFP season. So talk a little bit about, Chad, how shippers are looking at, the rate negotiation process, because carriers, as Adam's talking about, are trying to find a way up as opposed to a way down.
Yeah. So we've heard that. So right now is RFP season. They're putting their RFPs out to bid. Those long-term contract rates take 3 to 6 months to negotiate and put in place. So we'll see those start to execute, the majority of them in March, April. And what we're hearing from some shippers is that they're testing the market first half versus second half. So normally these large RFPs, which probably constitute about 80% of the marketplace, they'll negotiate those at an annual rate or even 2-year rate with maybe some sort of index to increase the rate after year one. But we are hearing from some that they're testing the market because they're expecting a different market in the second half than the first half. When we've polled our shippers, they expect moderate rate increases in the first half of next year on contract rates, and then a little bit more significant increases. But nobody's getting into the double-digit expectation. It's more of a gradual rise that they're expecting, which I think lines up with what most of us are thinking as well. I do have one question, Adam or Dean. At this point in the cycle, when it's really hard on those small owner operators, and you said, Adam, that the larger carriers are doing well. I assume that the larger carriers, as they anticipate the market to ramp some, they'll start to increase fleet size or driver count. Will we see a shift from some owner operators on board as owner operators for those larger carriers? And does that start to tighten the spot market a little bit as some of that capacity shifts?
So one thing let me correct. I don't want us to feel like large carriers are doing well, because nobody's out there just like throwing money in the air right now. That's not
better. Is it better?
Because obviously their cash flow is in a different place.
Yeah.
But when you look at the cost of equipment costs and you compare it to 2 years ago, you got large carriers that have contracts with their manufacturers that are able to get equipment costs at a much cheaper price. And when they exit their equipment, they're typically exiting equipment at 200, 300,000 miles and rolling that over into it. So now when we look at the operating costs, so they're having a lower operating cost these 2 years than they had back in 2022, 2021, because now they're able to save on equipment costs. So they certainly have an advantage when it comes to, as they need to turn over equipment, as they need to scale for new customers, as they need to bring on. Now, what we don't traditionally see is we see a little bit of a flip. So we'll see the owner operators and the small fleets look to either exit from their own authorities and then pull and tag along with the mega or a larger carrier when the market is soft. Not necessarily when things are kind of turning around, but for the ones that don't see what's happening, and to Dean's point, 1231, for the ones that don't see what's happening, they might say, you know what, I'm just going to tag on to a JB Hunt, I'm going to tag on to a Schneider, I'm going to go ahead and I'm going to lease on. But ultimately during this cycle, the ones that, I think it comes down to an investor mindset. You buy low, sell high. And I think right now, what you'll see is you'll have some owner operators that have truly been able to scale in this marketplace because you can get a piece of equipment for 40, 50 grand versus paying 80, 90, 100 grand for a piece of equipment. So the ones that made really good decisions 2 years ago, right? So the ones that are made fiduciary, they was able to save some capital, had equipment prior to entering in a cycle. Those ones are going to be the ones that's going to be better positioned to be able to scale in this marketplace. So I think that you're going to see, you'll see a little bit of both in all fairness.
Chad, the numbers kind of pan out. If you followed Todd Amon's ATBS show a couple of weeks ago, the average the average leased on owner operator rate per mile was $1.70. Todd talks about to run your own authority, buy your own trailer, have your own lumper fees, all the inefficiencies of live load, unload. You need about 50 cents a mile. So that puts you at about $2.20 a mile break even before you'd consider going from leased on, the safety net of being leased on owner operated to an independent contractor. So we're at $2 a mile now, thereabouts. So rates have got to go up at least 20 cents a mile before you'd really entertain that notion of going out on your own again, which of course we saw at the start of the pandemic, which I think was more an aberration than a normal migration of capacity onto the other side of the ledger on the independents. And I think to Adam's point, what we've been seeing is a very different cohort of independent contractors that are much more business savvy and have more equity in their businesses. And I think, Adam, that's what we're seeing in the spot market, is their ability to withstand lower rates is something I've not seen before. And I suspect it's got a lot to do with how much money carriers made during the pandemic, especially the savvy operators.
Yeah. No, I definitely agree with that. I totally agree with that. We've seen, obviously we've been able to see that, and we talked about it before. Some carriers even pay their insurance outright versus having to pay a monthly premium. So when you don't have, $1,500, $2,200, $2,300 premium payment coming out per truck every single month, and you're able to save that, that's cash, that's cash in hand.
Right. Right. I go to truck shows most weekends. I was at one yesterday, and folks are doing well. It's not everybody's hauling freight of all kinds, bumping docks. I think the bulk of the trucking industry is doing exceptionally well. Now, of course, when you talk to truckers, they won't tell you that, right? That's kind of taboo. No matter how good things are always bad, because you don't want anybody else knowing what little good opportunity you've got. So, but when I look around at carriers, their equipment and what they're doing, and the fact they can spend so much money on stainless steel, I think the trucking industry is actually in a really good position. Now, that said, I think there probably are some carriers right on the edge right now, and we've seen that for the last couple of years. And that's got a lot to do with maybe an inability to understand operating cost or broader market cycles, because if you entered in the last 4 years, it's been all up and all down. Like rates went up 30% and then they fell 30%. Which is very different. I'm getting to a question here, Adam. This is very different to, say, pre-18 cycles where rates maybe went up low single digits year over year, and then was more like a wave as opposed to a mountain peak. Do you have a sense that next year is more a consolidation year where we return to, pre-2018 type freight markets where we really weren't talking about freight market volatility?
I can see that, and I truly believe there's not going to be a switch. We talked about, okay, when the hurricanes hit, this is going to be the switch that flipped the markets. I've heard all of it. I've heard all of that, but it's always a pendulum. A pendulum never ends up from one side to the other side without swinging through a trough and gradually making its growth. And so when I look at 2018, and I even look back, one of the worst years that I had was 2006 or 2008. That was one of the worst experiences that we had. But it's always a slow, gradual change. And it's almost the thing that you're going to look at and you're like, man, it's not so bad today. I wonder what happened. It's not going to be a light switch, just like, what happened back in 2020 during COVID. All of a sudden things kind of just changed dramatically. But I think it's just going to be a gradual, unnoticeable, kind of one of those things that just ends up one day and things are not going to be so bad. I could be wrong, which, obviously we're just analysts and we're just making projections. But I've never seen anything that would cause me to think differently.
Yeah. Yeah, that's very interesting. Well, we're almost up on time here. Chad, anything else you want to fire?
Yeah. One last question, Adam. So I work with a lot of shippers. How would you advise a shipper as they move into this tighter market? They want to be attractive to carriers. We've all heard shipper of choice, right? This is something shippers talk about. How do they make themselves more attractive to carriers and make their freight more easy for carriers to move?
Yeah, I think the efficiency is the biggest thing for a carrier, and being respectful of a carrier's time, especially particularly around appointment times and settings and things like that. Getting a truck in and out is the best thing that you can possibly do to a carrier. If I show up and I'm ready to, if I show up for a delivery, the efficiency of getting that truck unloaded and the lack of urgency, they usually go in two different ends of the spectrum. So it's really important to focus on the carrier's time and understanding that, time is money within that carrier, and it provides that carrier the opportunity to be able to serve another receiver or another shipper with the same set of services that they wanted to serve with you. You got to remember, a carrier's sole focus is to deliver customer service, and allowing that carrier to be able to be efficient in delivering that customer service is a true win in that direction.
Sure. And the reputation stick with them, I would assume, right?
100%. 100%.
Yeah.
That makes sense.
Thank you, Adam. Love having you on the show.
Thanks for having me.
A couple of shout outs before we go. Chris Kaplis on the Freightvine podcast is talking to our very own Chief Information Security Officer, Erica Voss. Don't miss that one. She has a great take on the difference between fraud and cybersecurity. On next week's show, we have Larry Gross. He's talking about the inland intermodal freight market. Of course, that's one of the biggest competitors for truckload carriers. Adam, before we wrap up, how can people contact you?
You can go directly to our website, www.innovativelegisticsgroup.io. You can follow me on LinkedIn at Adam L. Wingfield. You can follow me on Instagram at Adam L. Wingfield. And you can follow me on Twitter, X, whatever you want to call it, at Adam L. Wingfield. So you can find me pretty much anywhere.
He's there. He's everywhere. What was that cartoon from the 70s? Chicken Man, was it?
Yeah, that's what. Well, I was a little before my time. Just a little.
Sorry. I think I'm on my own island right there. All right. Okay, everyone, that's another show in the books. Make sure you sign up for the live alerts, subscribe to DAT Freight and Analytics. And with that, another show's in the books. Be safe, be nice to everyone. We'll see you here again next week at 10 a.m. Eastern, 7 a.m. Pacific.